Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, January 13th, 4:52 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's big show, the weekend edition, the Friday night edition of the Revere Market Insight video, where we take a look back at the prior week, update important levels for next week, and review the newly updated world famous 21 over 21 leaders list. Let's jump right into it. State of the market has been upgraded from correction with a short-term uptrend to uptrend, correction with a short-term uptrend to uptrend, but with caution, and I'll explain that momentarily. You can see over here on the trend gauge, reviewing the progress of the 21 over 21 over the prior week. There's just no denying that leading stocks have acted very well. In fact, the market as a whole has acted very well this week, attempting sell-offs for 4 straight days, finishing at the top of the range 4 straight days. And every time we tested a key support level, the bulls showed up and carried it away from that support level higher, and finally ending the week with a close above the 200-day moving average and the 40-week moving average. You're just ignoring what's actually going on in the market over these past 2 weeks if you don't say that the market's acting well. So leadership upgraded from neutral to bullish. Short term, we upgraded this on Wednesday to bullish. Medium term upgraded today to bullish. All indexes with at least 2 closes above the 50 day moving average, and including closing the week above it. We had a strong close to the week. That is always important. Long term, we've also upgraded from downtrend to neutral, with 4 of the 5 indexes closing the week above the 200-day moving average. The slopes of the lines are still pointing lower. It's going to take quite a bit to get this off of neutral and onto bullish. And then of course we've got the holdout NASDAQ 100. But just because 6, 7, 10 stocks are holding back the S&P 500 and the NASDAQ 100, when you've got the equal weight NASDAQ 100 above the 200-day, the equal weight S&P 500 has been above the 200-day. You got to take a broader look at the market and not necessarily just what the top heavy indexes are doing. So what just happened today? Today started out ugly. Bank earnings came out before the close, and the market was down a little bit and just sold off. Starting at around 8 o'clock to 8:30, going up into 9 o'clock. We opened near the lows of the overnight session, down 0.75%, but that was it. Within 5 minutes, we put in a low. Buyers came in. This was just right. We bottomed at 39.47, which is right near that 39.50 level, and couldn't go any lower. Buyers came in, took it higher. We based for a few hours, went a little bit higher, based again a little bit higher. Just the type of action that bulls would want to see. And once again, saying anything else is arguing with what's actually going on in the market. So, and also growth, small growth outperformed on the day. The G6 up 0.74%. Always good to see that. Certainly progress being made in the G6 charts. S&P 500 up 0.4%. NASDAQ 100 started out as the weakest index, ended up as the strongest, up 0.7%. Dow up 1/3%. Mid caps up 0.5%. Russell 2000 small caps up 0.6%. Global diversified 60/40 up 0.14. Held back by bonds. Bonds down 0.32. Bonds down, that means yields higher, which we did see today, but the higher yields and the dollar basically doing nothing didn't hold back stocks, especially strong late morning and then again later in the afternoon. In-house GROTECTION up 0.26%. We increased our exposure from we'll go through it when we hit the tail of the tape, and then of course we'll update the 21 over 21 leaders list. So let's get right into it. What makes us different at Revere from any other asset manager? Well, certainly protecting your downside. We're an active manager that lets the market tell us if it's healthy or risky, and we allocate resources accordingly. If we're trending above all the moving averages, short term, medium term, and long term, and leading stocks are acting great, we'll be as heavy into the market as we possibly can be. Things start to slow down, roll over, our stops will take us out of the market. If we really start to correct more than 5, 6, 7%, the slopes of the lines of the short term and medium term will start to roll over. And if we break below this big bad black line, such as we did for the first time last January, poked our head back above it for a couple of weeks, underneath again, back above for a couple of weeks, and then a critical day on April 21st with a big negative reversal kicked off the second leg. And then we had a third leg down, mostly based on restrictive Fed policy and inflation data. But as that inflation data has started to get better and the Fed has started to back off of their interest rates, at least cut them down from 75 to 50 and now projected at just 25 basis points for the next two, the market is starting to see things a little bit more clear. And really, the question is, what's the reaction going to be when earnings start coming out? Well, right out of the gate today, three big banks gap down 2, 3, 4%, and you're thinking, oh boy, if earnings are going to start driving the response to what the markets are doing, and this is just the kickoff, we could be in for some trouble. But the bulls did exactly what they needed to do, right at support again, and carried us higher with a close above the 200-day moving average. Why do we get so concerned when we're under the 200-day? Because all of these bear markets occur when you're under the 200-day. If you can preserve your nest egg, stay within 10, 12% of your all-time high, this is what we set out to do. And it's very easy to recover from those drawdowns. Not to mention, you can rest your head on the pillow, not worrying about your nest egg if you know you've got your downside protected. So we're down a little over 12% for the year, while at worst the market was down 27.5%. Now we bottomed. We're participating in the recovery. There's a transition period off the bottom always where we'll lag for a little bit. But when things are configured correctly and leading stocks are acting, we can really put up some solid returns with the wind at our back. If you're interested in this approach, give us a shout. You can email don@revereasset.com or phone 855 Real Wealth. That's 855-732-5932. So uptrend with caution. Let's go through the indexes. Here's the S&P 500. We'll go to a 5-minute chart so that it's very clear. You can see the gap down, and within 4 bars, put in the low. And then a nice rally headed higher back to 39.80. 39.80, a key area all throughout yesterday. It's where we opened, it's where we recovered to, it's where we pulled back to during the day, and that's where we paused on the first leg up. Then a 3-hour base, another break higher, another hour base, another break higher. This is exactly what you want to see in a bullish market, and that's what we saw today in the S&P 500. Not to mention the close. 39.81 is the declining 200-day moving average now. We closed 18 points above that. This is continuing to trend lower by about 2, 3 points each day. At some point, these prints going back 200 days will start to come off, and the slope of the line will start to curve higher as long as price continues to participate. And really, now when we test these moving averages that are going to come up to price at some point, that's where the rubber meets the road, and we'll see if this rally has legs. We've seen it failed here in August. We've seen it failed here in November, again in December. We're giving it a shot again in January. We based for a nice 3-week period here to give us a launching pad. Now we've basically been up 6 straight days. We had that pullback to work off a little bit of the bullishness over the last 3 days, including the CPI reaction, and bulls did what they needed to do today. And as long as they do, you You can't just say, but we've got this going on and that going on and the other thing going on, because that's arguing what the market's actually telling you. Here's two closes above the 50-day moving average, basically a flat line 50-day moving average on the Nasdaq 100. Certainly good there, but you can see that we're still 5% below the 200-day moving average. Dow Jones Industrial Average, another good day. Great looking chart here. Uh, again, well, lagging slightly, but that's not a problem because that's what you expect from a lower beta um, index relative to the S&P 500. It loses less when you're going down. It makes less when you're going up. One exception very clearly was October, November, where it was the leading index as money was flowing into it while we were coming off of that third leg down. So there's the Dow. How about mid caps? Continued strength, up 0.5% today, multiple closes above. Once we broke above this 448, 450 area, we've been off to the races, basically 6 straight days up on the mid caps, acting very well. You can see the relative strength line continuing to point up there, and small caps starting to participate also, since they're finally getting some help by the growth portion of small caps. Three closes above the 200-day, four above the 50-day, up for 6 straight sessions. That's outperformance. You can see the relative strength. That's also very healthy. So good stuff from small caps and mid caps. Got to show the equal weighted because, again, uh, a weekly look how much time it spent above the 200-day back here in November, and now a week plus above the 200-day in January. This is really what the S&P 500 is doing, not the being drugged down by the, as I said, those top 10 weights in the S&P 500. But we're starting to get some performance out of some of those big stocks. Look at Amazon this week, up 14%. If these things start chugging higher too, that Nasdaq 100 is going to catch up and pass the S&P 500 very quickly, because the weights are just so heavy that if they start acting well, they're just going to propel the rest of the market higher. If you're done with the selling in them, there's nothing to do but start accumulating them back, or you're going to be lagging the benchmark. Um, that's what money managers are looking like, and that's exactly what happened with Amazon this week, no question about it. So RSP, QQEW, there's your equal weighted, three closes above the 200-day moving average, again acting better than the Nasdaq 100. What did the dollar do today? Basically tight after moving down yesterday and spurring the CPI move higher. Just a little flat line here, trending lower below the 80 MA. I commented yesterday on some things that I read and how this is typical, that the dollar really starts to weaken when the global economy does not have the big fears that it had with, for one thing, Russia, another thing with inflation, as it seems to be taming somewhat across the globe. Let's go to the VIX. After a big move down yesterday, we're moving even further lower today. The VIX closed at 1823, the lowest close going all the way back to January of last year. Now, stocks are not back to January of last year, but the VIX is. We're due for a snapback rally, but the trend on this is exactly what the bulls want to see. Let's go to a couple of other charts here. Let's start off with junk bonds, JNK. And multiple closes above the 200-day moving average now, so there's no fear in credit land. The broad BND index right at the 200-day moving average. LQD corporate bonds, multiple closes above the 200-day moving average now. TLT, the 30-year, inside day relative to yesterday, positive volume patterns over the last 2 weeks, and little tick up in bond yields today. So this 34 area is holding as support. That's the equivalent, I think, to 3.40. Let's go to TYX, the 30-year. Little bounce off the bottom after a big move down yesterday. Gold and gold stocks, dollar didn't do anything, but they participated to the upside. Gold making a higher high. Look at the bottom volume patterns in GLD. Silver SLV starting to reassert itself after lagging oddly for about a week and a half. You can see the little handle there forming in the cup base, and GDX gold stocks continuing to ride the ADMA higher. Bitcoin had another good day, and this is very clearly a risk on move in Bitcoin. Um, Two very strong days in Bitcoin, and I think that goes to the overall risk tolerance of the investor in general. So let's go to the tail of the tape now. I didn't update this with the VIX here. It was below 18, fear and greed out of 57. So you'll note the market state uptrend with caution again. Uh, this bull case, bear case, will this bear case won't be highlighted anymore. We'll put the criteria for going back to the bear case. I'll update that over the weekend. Definitely the news, those three big banks drop at the open and positive reversals. Our day count, we've now been up 6 days, above the 80 EMA for 6 days, above the 21 EMA for 6 days. Expectations positive. Gap down and a positive reversal is definitely a positive reaction and reinforcing our expectations. As far as the levels for S&P, we gapped down to the 3950 support resistance area and then got above that 200-day moving average at 3981. Gap down in the NASDAQ 100, excuse me, but rallied above this 278.50 to 280 area. There's the action intraday. Let's see what else here. Not a number of huge standouts versus what the indexes did for individual sectors. Bond yield percentages higher. Gold, silver, and gold and silver stocks outperform. Banks started out terrible, closed strong, and financials in general also. Bond prices down. Biotech, XBI, the small biotech, lagged. Aerospace and defense stocks got some downgrades and they lagged. XLI, that's industrials, utilities, and real estate lagged. Our focus will be the 21 over 21 list, which we'll go over here shortly. Let's take a look at what we bought today. Start off with SSO, and this is predicated on the S&P 500 chart. When we did well, let's bring up a 60-minute chart. Very clear that that 3950 is a support area. Here, it was resistance. We got above it yesterday. We back tested it, got above it, back tested it again today. When we bounced off of that, we added more to our SSO position. And NASDAQ 100, when it came down and touched that 50-day moving average again and started to move off of it and make a higher high, we added a QLD position. Let's see what else. AEHR, which we stepped into yesterday. We added more to that today. That's starting to reassert itself again after a nice pullback to cool off some of the overbought condition there. And we bought JP Morgan and XBI, the biotech. XBI broke out yesterday. And started higher today. When it started to pull back is when we added to it. It's just a little bit below where we got in at. Note the how this is the perfect setup as far as how tight all the moving averages are, and then they start to fan out as the stock goes higher and provide support on any pullbacks. Change of character for biotech, you can see tried to break out here, failed, tried to break out here, failed, tried here, failed, failed. Just continued to base, but never broke down. Relative strength held up fine, and now finally you get the move out above that 84, 85 level. So we participated in that, and then we also bought strongest of the bank stocks, JP Morgan. This is exactly what you want to look for. Look at the volume on a 5-minute chart. You see the gap down, and after it gapped down, it was immediately bought, and this is just buying until midday when it cooled off and just went sideways for a while. But this is exactly what you look for an inflection point and a shakeout. You've got a very clear stop out. It should not move below today's low. So we added that to the portfolio today. The net change to the portfolio was we started the day with adjusted beta of 50%, or half the risk of the S&P 500. We're up to 70% now. So basically, more risk than the traditional 60/40 portfolio would have now. Those are normally about a 0.68. A 60/40 diversified portfolio, we're at a zero point 0.7 here, and if things continue to work, we'll continue to add to them. So the bottom line for today: gap down on bank earnings, initial reaction, strong positive reversal, close over the 200-day, another win for the bulls. Let's take one more look at the S&P 500, and you can see those positive closes the last 4 days, where started off weak or tried to sell off, finished strong. That's Tuesday, gapped up, finished strong on Wednesday. The CPI volatility finished strong. A little bit of a pullback into the close, but not much off the highs as that 4,000 resistance reared its head again. Gap down, started buying it immediately. Base closed near the highs for the week. 4,000 is a big level. There are two key fib levels between 39.98 and 4,007. Yep, 39.98 and 4,007. So definitely a big resistance area here. We just want to make sure next week that all pullbacks are contained. Now we'll go to the 21 over 21. We'll start with what got punted out of here, starting with ELF. As Greta Thunberg said, "How dare you?" But that's what ELF did to our portfolio this week. Big break below the 50-day moving average, followed up to the downside. Now to lower volume bounce days. This is a place to exit. Lower volume bounces after heavy volume sell off into broken support, turn to resistance is a place to exit. If I didn't get out 2 days ago, I would have been selling today, but we're out of that. UTHR, uh, big break early in the week, really no recovery, severe lack of relative strength. This one's biting the dust. SARC, the inverse, ARC ETF, gap down Monday below the 21. The 21 rolls over, closes at the low for the week. This is what you want to see in an inverse ARC ETF, absolutely. So good stuff for ARC on the other end. SARC is gone, and finally AVGO. Now, this is above the 21, and it recovered from this big gap down. But with the overhang of the news that Apple's going to go away from their chips, this is just not something I want to be involved in for the time being. With that overhang, note the relative weakness this week while other things were going higher. This would have caused angst. No need for that in a portfolio. So although it's above the 21, better stuff added to it. And now these first four are what were added, and we own 3 of the 4. So there's JP Morgan. We already discussed this. Biotech, we added this with that breakout. XBI added. RVNC, this is a biotech with that massive move up on volume, 3-day pullback, just what you want to see, and now reasserting itself. This is kind of like a morning star where you go up strong, you start pulling back the third day, down, puts in the bottom, and then it's a 3-candle combo. When you go past midway of the first candle, that's a buy signal, and that's what RVNC did today. We do not own it though. AEHR, I mean, added this back to the portfolio after selling it when it was extended. JD.com almost punted this one because today it did the complete opposite of what the market did. Big gap up. I was actually sized up a buy for this and was considering doing it, and then it topped and it just started to pull back. So I said, okay, let's wait for this pullback to stop, and it didn't stop. Came all the way down to where the stock was negative on the day. That's not how this should have acted. So, and it's really lagging what some other China stocks are doing. Today, I thought was the time for it to resurrect itself off of this ADMA. It's still holding the ADMA, keeping it on here, but it's got 1 foot out the door, so to speak. Maybe it writes itself, but there are a lot of other Chinese stocks that are acting better than this. This was a low risk entry point if it would have worked, but it really didn't do what it should have done today. I really don't like that selling that came in. The numbers are great, not necessarily for the last quarter with only 1% sales gain, but the earnings numbers are great. And maybe it's that sales that are making people shy away from it, as the last 2 quarters haven't been good. But then again, things haven't been so good in China either. Moving on, Las Vegas Sands continues to rock after the China reopening in Macau. Nike acting perfectly from an earnings gap up, went sideways till the 8 caught up to it, higher high, continuing higher. Not a big move, but it's doing exactly what it should be doing, and it's showing relative strength. Pick, uh, 7 straight up days for Pick. Michael brought this to our attention. Uh, Great looking stock, great action, great sector. They're focused on the picks and shovels for the mining industry, not the precious metal mining industry, the base metal miners. Alta, uh, relative weakness this week, but it's at the top of its range. Not really shocked after it moved from 436 up to 490 in the span of a couple of weeks. GE, man, I did not expect this out of GE. Blue dot now, need a pullback for this. Look at those blue bars. Um, Definitely have FOMO on this one. Schwab undercut reclaimed the 21-day relative weakness this week. However, uh, earnings next week will probably be the thumbs up or the thumbs down for this one. Crocs continues to trudge higher. This is exactly how you want a growth stock to act, and finally getting the market to do it. It's showing what it can do. Caterpillar continues 4 days tight near this 250, busted out above it yesterday, even higher today. That just looks fantastic. Halliburton, same thing, reclaimed 40, uh, 8 straight blue days for Halliburton. Lennar uh, survived the gap down in one of the other builders this week. It was KBH yesterday. Let's take a quick look at that for a reference. KBH gap down on earnings, and look at that, put in a low immediately, and now it's above the high of yesterday. So this is an inflection point, gap to the downside, where it got all the sellers out that it needed to. Strong group. Lennar's also in that group, and acting great, riding the ADMA higher. MDGL, um, with this big approval that they got, ran from 200 up to 300, doing what these big gaps should do. First touch of the 8, it bounced off of it, and it's just riding it higher. NVO, rough week of definitely of relative weakness, but it's just time for this to cool off a little bit after that nice ride up on the ADMA. They don't go up forever. Shift 4 payments closing the week at highs after an upgrade earlier in the week, along with Visa and MasterCard. GDX already showed this, but just continues to trudge higher. We sold our nugget when it was extended, looking for a pullback to get back into this. 5 below. This is one that I bought on that gap up, but it didn't, because the market was still coming down. So it didn't act the way a gap should, but it's acting the way it should have now after I got stopped out below the 21. You can't get them all 100% correct, but this is a really good base that this is putting in here. Really, arguably a cup with a little handle, although the handle's a day too short at this point. And Boeing continues higher. We sold it, extended it, pulled back to the 8, survived a downgrade this week, and just one of the strongest stocks in the market. And that's your 21 over 21, and that's going to wrap it for the week. As always, love to hear from you. The email is don@revereasset.com, or my partner Dan Stewart, dan@revereasset.com. The phone is 855 Real Wealth. That's 855-732-5932. Remember, it's not how much you make in the markets, it's how much you can keep. There'll be a point when I can stop saying that, when we're in an uptrend, and more monitoring pullbacks to moving averages, and not moves up into moving averages that failed. That's when you know that the state of the market has changed, when they offer support. Moving averages offer support instead of resistance. And that's going to do it. Wrapping up the week ending January 13th. This is Don Vandenbord. Just the facts here at Revere, telling it like it is. We're telling you what's going on at the market. I know there's a lot of bad news out there with the supposedly a recession looming, but we've been saying for weeks that the market will bottom before the economy bottoms because the market looks out 6 to 9 months. And that just may be what we're seeing, that we could see that recession and it's mild, but stocks are looking beyond that. That's it. Thanks for listening and have a great 3-day weekend.